This past week, we read of massive layoffs by banks and their mortgage divisions. Between Bank of America, Wells Fargo, and Citigroup, about 8,400 jobs were shed, with more to follow in the fourth quarter. The first cause of these layoffs is rising interest rates, which lead to lower refinance rates. The second is an improvement in the bank's distressed portfolio. Less people are required to service and resolve these types of loans, so banks opened offices in many cities and hired up to meet these dual requirements, but no longer need the personnel. Now these cuts have hit cities like Danville, Illinois, Des Moines, Iowa, Charlotte, North Carolina, South Jordan, Utah, and Sunrise, Florida. What mortgage banks need are more jobs, specifically table jobs, which in turn will bring home buyer loans. Unfortunately, we're in the midst of an anemic recovery being further impeded by political gridlock. The greater number of layoffs, the more uncertainty among the gainfully employed, and the lower the probability of commitments to home buying. It's a vicious cycle. So for investors looking at real estate, it means that housing prices will not be going to the moon anytime soon in many metropolitan areas. There's still a good opportunity to buy, but investors need to be wary and avoid cities that are overly dependent on industries that are likely to see softness in the near term. Low employment also impacts qualified tenants. It's the engine of cash flow for investment real estate.